which is open to the press and public on request. This meeting will not be broadcast live. However, a recording will be made available as soon as possible after the meeting has concluded. As ever, we welcome the use of the Welsh language at meetings. I've had no requests for people to speak Welsh today, so this meeting will be conducted in English only. May I remind members that, as per statutory guidance made under Section 4 of the Local Government (open brackets) Wales Measure of 2011 and our formally adopted hybrid meeting policy, any member attending a meeting remotely must be able to be seen and heard by the members and officers who are attending the meeting, as well as by members of the public viewing the meeting. So can I ask that you both please use your cameras for the duration of the meeting? Well done, both complying. Can members attending via Teams refrain from using the chat function and instead use the raised hand icon to indicate when you would like to speak? Please remember to keep your microphone muted when you're not talking. With that, we'll move on to the agenda. Item number 1, attendance and apologies. Jade.
Thanks, Chair. We've had apologies from Councillor Tew.
Very good. Thank you very much. Item number 2, declarations of interest. Again, back to Jade.
Thanks, Chair. So starting with Councillor Best, can I just confirm that you have no interests?
Yeah, no interests.
Thank you. And Councillor Gordon, I've got that your self, your wife, your stepdaughter and your stepdaughter's partner are a contributor to the fund.
That's correct.
And I've got a personal interest due to your work as a Unison official.
Also correct. Thank you.
Thank you. Then Councillor Hawler, I have that you're a contributor.
That's correct.
Thank you. Councillor Williams, I have that both yourself and your wife are both in receipt of a pension and contributors.
Correct.
Thank you. And yourself, Chair, I have that your father and 2 other family members, your aunts, are in receipt and you're a contributor.
That is also correct.
Thank you.
Thank you very much, Jade. Before moving on to agenda item 3, I thought it might make sense to go around the table today to make introductions, because we're joined by, there's a new face around the table today, so I'd like to welcome Andrew Lovegrove to the meeting. He will be taking over as the Director of Resources in January, when Nigel finally takes his leave. So if people are happy, I think we will go around the room today. So we've got a mixture of committee members, staff, board members and our independent financial advisors. So I'll kick off. We've met before, but I'm Nathan Yole. I'm the chair of the Pension Committee.
Joe Griffiths, I'm the Pensions Manager.
Jade Harvey, Democratic Services.
I'll do the room first, then we'll go online.
Elizabeth Carey, I go by Betty, independent research analyst. I work really closely with Alex and Liz.
Alex Ball, head of the Pension Fund. And members of the board can introduce themselves as well.
Steve Harford, a member of the...
And then if those of you online could also introduce yourselves, please. John, do you want to kick off?
John Hawler, councillor for Torvine.
Carl Gordon, councillor for Lanfrac and Pontier.
Fiona Phillips, pension fund accountant.
I think that's everyone. All right, thank you very much, everyone. Moving on then to the scheduled agenda. We've got agenda item number 3. These are the minutes of the Pensions Committee for the 24th of June 2024. These are for members to raise any issues and then to agree. These begin on page 5 of the agenda. Does anyone have any questions? Does anybody have any issues they'd like to raise? And then we'll take it from there. So, Joanne.
Thank you, Chair. Just to mention, there was an action on me, point 5.2 from the previous minutes, to provide some information about my pensions online registration figures. I've sent an email round to members this morning, setting out the membership details for all the Welsh funds. And if you have any questions or want any more further detail, then please let me know.
Okay, thank you very much for that update. Anyone else? In which case, if people have read the meetings, members will be happy to agree the minutes. Agreed here, chaps online, fantastic, in which case they are agreed. Item number 4, this is for information only, but they are the draft minutes of the Pension Board meeting from the 24th of July 2024. These begin on page 17 of the pack. Actually, Ian, other members, as you're here, is there anything in particular you'd like to point our attention to, or anything you think might need clarification?
Thank you, Chair. No, nothing to answer.
Thank you very much. In which case, members, are we all happy to note these minutes? Yeah, online. Fantastic. Thank you very much. In which case, item number 5, first substantive item of the day, we have the administration update. Joanne, this starts on page 33.
Thank you, Chair. So, just a few updates from the administration perspective. All annual benefits statements have now been uploaded to members' My Pensions Online account in line with the statutory deadline, and letters and emails were sent to all members notifying them that they were now available online. And this year, for the first time, we've also uploaded members' additional voluntary contribution statements online. So far, things seem to be going well. And you'll see later on that it has resulted in an increase in the number of members registering for My Pensions Online. So the newsletter this year included a number of topics like we do every year, and the list of topics that we provide is in 4.2, just trying to give members some further information about pensions in their annual newsletter. Moving on to point 5, so Pensions Awareness Week was held last week, and it's a nationwide event, and it aims to improve people's understanding of their pension. So the fund has offered scheme employers the opportunity to hold pension awareness days. We offered this during the week, but we also extended it if they wanted to hold a session after the week as well. And to date, we have only had one employer respond to us, asking us to arrange a session in the coming weeks. During the last 3 months, the fund has also carried out a number of training sessions with employers. This has included member and employer training, and the sessions have been very well received, and we've received positive feedback from the employers. Moving on then to point 7, so My Pensions Online. As I mentioned, the emails and letters notifying members of their annual benefit statement has resulted in an increase in the members registering for My Pensions Online. And checking the data today, 1,489 members registered between 31st of May and today's date. So that's positive going forward. Cyber security, so I continue to meet with the Chief Information Security Officer on a monthly basis, and there'll be a training session after today's Pensions Committee on cyber risk, which I hope you all can attend. And in December, we'll be carrying out our annual cyber tabletop exercise with Hayward Pension Technologies. With regards to McLeod, so the fund continues to work on all business as usual McLeod work. The Ministry of Housing, Communities and Local Government issued final statutory guidance on McLeod implementation. And point 9.3 of this report provides details of a limited technical consultation that was carried out regarding the underpin information and the annual benefit statements. So at the time of writing the report, we were waiting on the outcome of the consultation, but on the 28th of August, MHCLG laid the LGPS Information Regulations 2024. So these regulations basically remove the need for us to provide the underpin information in the 23-24 annual benefit statement. If the regulations hadn't come into effect, then we would have had to report this as a breach to the pension regulator, and all funds would have been in the same position. So that's good news from the fund perspective, but we will then need to include the information in next year's annual benefit statement. And then finally, work continues on the pensions dashboard, and we are working with Haywards to procure the ISP for the pensions dashboard. So I invite any comments.
Great stuff. Thank you, Joanne. I've got some questions, but I will defer to the other members first. So does anyone have any questions they'd like to ask Joanne? David? No? Either of you on mine? Okay, I'll barrel through then. So the first question I've got is going back to point 6 about training. So how did the training sessions go? Were they well received? Is there any learning from them in terms of what we can take forward?
Yes, the training sessions went very well. We're getting more and more employers approach us to ask for training. We're advertising it on a quarterly basis. So yes, we're learning from it. We're hopefully going to be sending out surveys as well to the employers and the members going forward, so we can get even more feedback from them and build into that. But yes, they're going very well.
Second then, I've got 3 questions. Actually, I'll take the next 2 together. I think we probably talked about this last year, but going back to point 7 in the report, what else do you think it's possible for us to do to increase take-up of the My Pensions Online, at least from members currently paying in or are deferred? And then on point 8 on page 34, point 8.3, I'd be quite interested if you could talk us through what the annual cyber tabletop exercise looks like, although if this is going to be that is sensitive information, I'm happy to state that in the exempt part of the meeting.
No, that's fine. So yeah, with regards to increasing the membership, we need to communicate with the members more often and advertise My Pensions Online to them more often to try and get them to register and sign in for the system. Currently, we do it on an annual basis. However, we have got email addresses for a number of members who aren't registered, so we could start sending more email shots out to them to try and increase the membership, and also get the employers to advertise My Pensions Online through the avenues as well going forward. So we are doing part of that already, but we probably need to do more to try and get that increase up, especially looking at the other membership across the Welsh funds. Yeah.
What, are we lagging behind some of the other funds?
We are lagging behind some of them. However, what we do need to bear in mind is that we moved from an old My Pensions Online system to a new system within the past, in the past 4 years, while other funds have been on there for much longer. So we had to start all over again when we moved on to Hayward's My Pensions Online system. So we are, at par with some of the funds, but other funds have got more membership than us. So we know that we do need to increase that numbers, and it is going up every year, but we do need to try and promote it more.
Have we set ourselves a target?
We haven't set a target as of yet, but that's something we can have a look at.
Without wishing to give you too much work, it might be quite good if we work out something that's actually that is achievable over the next couple of years.
I'm not sure, sorry, Alex. So we've got a target set up in our quarterly reports that we send, have we?
So as part of our sort of service plan and the business plan, we set ourselves a target of about 40%, I think, for the current financial year. But what we're trying to achieve is a year-on-year increase in that, recognising that once we have the bulk of the membership using the system, it allows for more seamless flow of data back and forth. What I would just say is, I think, to Joe's point, I think we probably have to do more with our scheme employers to promote the engagement of the system through them and through their own communication, given that it's in the employer's interest as well to have this in place. And I know that a number of the scheme and employer representatives on the local pension board have previously expressed an interest in supporting us with that. So I think part of our push and our promotion of the system needs to come through that as much as directly with the membership.
Yeah, I think as ever, it's got to be a bit of a push and pull on both of them. And in future, I'll make sure I've read the business plan before every meeting, so these statistics are the forefront of my brain. David.
Yeah, I'm sure, Chair, that a word from yourself alongside that of some of the officers would be very helpful to raise awareness as well.
Yeah, sure. I think... sorry, Joy.
Sorry, I just want to say as well that Hayward there is going to be a new My Pensions Online system coming into force called Engage, and that is going to be more engaging, I suppose, as the word said. And there'll be things, potentially things like online annual benefit statements and things like that. So hopefully we can build that in as well to our plan going forward to try and get more people engaged and more interactive with the way that they work.
That's encouraging. Just to double check though, that's a new system that they are implementing. That's not going to have any effect on us having to go back to scratch and rebuild that up again.
No, it should be a move over.
Fine. And just to go back to your point, Councillor Williams, on the informal setting, it might make sense actually, Alex, if the next time we put out some communication for more formal engagement with the other authorities and the employers, that we add it to a message to the leadership. Okay, lovely. Anyone else for anything? No? In which case, could I draw members' attention to point 11 on page 35? The recommendation at 11.1 is to note the report. Are members happy to do so? Yeah. In which case, that's agreed. Thank you very much. Next item is agenda item number 6. These are the draft annual reports and accounts for 2023-2024, and this report is going to be given by Alex and begins on page 37 of the consolidated pack.
Thank you, Chair, and good morning to all members. So, as introduced, this is essentially the draft report for the pension fund and report and accounts. It's a little bit of an echo. It's not bad. So, apologies, as I was saying, the draft annual report and accounts to the end of the financial year, 31st of March 2024. I'll just make a couple of introductory comments on the sort of the substance of this report before moving into some of the detail. So just for members' benefit, as a reminder, the pension fund is subject to a separate set of audit and accounting arrangements to that of the council. Hence, we're going through this process independently of that. The report remains in draft, and the reason is primarily that we haven't had a kind of sight of the ISA 260 or the final audit report. That we hope will be with us in the next couple of weeks, and we can conclude this process ahead of the 1st of December statutory deadline for the publication. As ever, we prepare the accounts, which are embedded within the annual report and actually start on page 109 as a reference point. They are prepared in line with the council's closed-down timetable, and so we had completed that in May, and they were then made public, I suppose, as draft for comments from members of the public as well. What I would say around this year, there's sort of standard process really, but we did receive some annual report guidance very late in the day in April, and that was a sort of the first time that any guidance has been prepared for pension funds since 2021 by the former SIPFA Pensions Panel Group, which disbanded at that point in time. Sorry, I should have said the guidance was 2019. The group disbanded in 2021. So within the revised guidance that we received earlier in the year, in essence, the message has been there's a best endeavours basis for this financial year. Given the short notice, there is an expectation that from the 24-25 reporting period, that the changes to the guidance are fully implemented. Officers, my team have worked really hard this year to implement as much of that new guidance as possible, and that does feature within the annual report. There are a few areas where essentially we require more data and time to really process that data before we can put it into, before we can publish it, and that's not just as a fund, but as part of the wider Wales Pension Partnership alongside our Welsh colleagues. I think at that point, really, what I would do is just to refer to some of the detail in the report. In essence, within the guidance, there were 3 key areas that have evolved. The first is around administration of the scheme and the key performance indicators that we report on. And in a second, I'll just refer to Joe, who may be able to touch on a couple of those for context. The other 2 areas, which are perhaps more topical in mainstream media at the moment, is around one, where the pension fund is invested and how much of that is invested in the UK market, whether in public or private markets, and then also more granularity and transparency around progress with the investment pooling, which is essentially with the Wales Pension Partnership, and how we are progressing with making fee savings. So I think at this point I'll just pause and pass to Joe on the administration KPIs, and I'll cover the second and third points shortly.
Thanks, Alex. So the KPIs on the annual report start on page 90. So the first, table A, reflects really what's been reported in previous years. Table B also reflects what's been reported in previous years. However, the descriptions have changed slightly from previous years. So there was additional information that we could use to identify exactly what part of the process that we needed to measure, which provided funds more detail, and hopefully will ensure that we can all report on the same KPIs across all funds. Now, Table C and Table D and E, these are all new KPIs that have been introduced for the first time this year. They provide a further breakdown of information. For example, Table C, you've got the membership details, and you've got a breakdown then by age. And then we've got communications, so that highlights the number of communications that we receive within the fund. And then resources and data quality, and there's further information on employer performance as well. As Alex said, it was best endeavours this year, so you will see that there are some areas that we haven't managed to report on, or some that require additional information for next year. However, we will be working on those now. We've put measures in place to be able to record those and report on them for next year. Just to touch on a couple of other things as well, there are additional information in this report on cyber security. That's important across all funds recently, and further information we've also reported on the dispute resolution as well. And I think that covers the main changes within the administration side.
Does anybody have any questions on Joe's section on the KPIs? Councillor Williams, either of you two online? No? David.
It was simply to ask whether those additional requirements had actually taken a lot more time. Was it reasonably seamless to be able to gather the information to provide the reporting, given the relatively late notices Alex referred to?
It did take additional resources and time to create these KPIs. We do have a reporting tool which we use, which extracts a lot of the information, and our system, Altair, which he would provide us with, they are aware of these requirements and have built to some extent what we're looking for, and they'll continue to build on that to make sure we can report on everything for next year.
Okay, thanks, Joe. So I think to the two other areas of the revised guidance that I referred to earlier on, if I could just ask members to jump back to page 63 of the papers. So essentially, one of the major interests of the UK government presently is about how much local government pension schemes have invested in the UK market, and that's across both the listed markets and unlisted, increasingly interested in unlisted. What we've introduced at the bottom of this page on 63 for the first time this year is a table that essentially extracts the fund's investment as at the end of the reporting period across each of those asset classes. And then we've also split that between what is in the Wales Pension Partnership pool, what is under the pool, under the management of the pool, so that's essentially our passive equity mandates, and then what is not pooled, so essentially what we still retain in legacy mandates. So as you can see, the bulk of the exposure is sat within UK listed equities. We are perhaps a bit of an outlier, particularly across Wales. There's only 2 of the 8 authorities that still have a UK listed equity mandate. But across the scheme in general, I think most have moved towards a sort of global exposure. So that's positive in terms of the message around exposure. And then if you move down that table, you can see we move sort of through our listed credit and fixed income into then what we've had for a long time, so sort of UK property exposure, and more recently where we've been investing in private debt infrastructure. You'll see at the bottom there's nothing against private equity. That's because the fund doesn't have a strategic allocation to private equity. Although in reality, increasingly what we see within our UK infrastructure investment is sort of private equity-like investments and investee companies. So I think the positive message here is that overall we've got about 20% of the fund allocated to UK. This hasn't just taken the exposures on face value either. One of the resource constraints for the team has been to sort of really dive into each of our portfolios and truly understand the makeup of the exposure. So as I'm sure you can imagine, particularly if you look at the government bonds and corporate bonds,
they are global mandates. And so the proportion of the UK is obviously small relative to that global mix. But I think, nevertheless, it's a relatively positive message that we have a fifth of the portfolio within the UK, with actually scope, particularly on the private markets, for that to increase in the years as we continue to allocate. So that was the first point I wanted to make around UK exposure. The second is in relation to investment pooling and fee savings. The initial guidance that the SIPFA Pensions Panel produced back in 2019 was obviously very early in the pooling journey, and I think things have become more sophisticated, and therefore the guidance it was necessary that the guidance has moved forward. It perhaps hasn't gone far enough, in my view, in terms of being prescriptive around exactly how we should be disclosing some of the requirements. But if I just turn to page 66, I can just refer to a couple of the points. I think I actually picked up the wrong page number.
Is it not 66?
It's not 66. It's actually 69 into 70. Apologies for that. So the bottom of page 60, or in fact, I'll just cover the top of 69 because I think it's important. So 74.5% of the fund, as at the reporting date, was invested via the WPP. So I think that's a positive message. There's scope for that to go further, and we believe that we've got some opportunities to do so later this year into the early part of next year, potentially. The bottom half of the table on pooling costs, this doesn't extend to the management fee costs, so the actual cost of managing the sort of 3 billion of assets within the Wales pool now. This is more the oversight and governance, so this is the sort of additional costs, if you like, of the pool, but where, over time this should demonstrate value for money in terms of that more enhanced oversight. So this has been a reporting requirement since 2019, I should say. So that's fairly standard in what you would see in prior years. If you move to page 70, there's a table in the middle of this page which is intended to show investment fee savings as a result of transitioning from what was historically fund legacy assets into the Wales pool vehicles. This is a little bit subjective in some ways, and that this is back to my earlier comments about the guidance could have been more prescriptive about exactly how you calculate this. But what this is intended to show is that as a result of our investment through the equity and bonds, so those listed assets we talked about, there's about a £1.9 million fee saving for the fund through the year 23-24, and cumulatively since 2018-19, which is the sort of start of the original SIPFA guidance, that's around just shy of £6.5 million in fee savings. So it's certainly significant, and I think that does generally demonstrate that the pooling is working for the fund and for Wales in general, and coupled with that UK investment, I think it's quite a positive message. I don't know if there's any comments on any of that before I just sort of conclude in terms of the kind of next steps with this report.
Thank you, Alex. Any questions or comments from anyone on that? I've got Ethan. Any members got any questions? I'm happy to take questions from or points from board members as well, but Ethan, take you first.
Yeah, obviously the fee savings are very impressive and of course illustrating the value of pooling. On the operating costs, what are any drivers to ensure that that is still at market or best achievable in terms of cost? Because that is the kind of the bit that I see it's gone up quite a bit year on year, and just what efforts are being made to ensure that that's in line with market.
No, I think that's a good observation, Ethan. So the operating costs, I suppose, if you take them in order, the operating costs, probably the most significant part of this is the Waystone contract, the relationship that we have. Waystone provide the infrastructure to the platform, essentially. So Wales hasn't gone down the route of creating its own fully FCA-regulated company, and as such, we essentially rent that capability. That cost has increased partly due to the scale of AUM on the platform, but also the creation of new sub-funds, some of which are trying to target areas that we have priorities around our responsible investment objectives, for example. Ways in which we can help to manage control that, I think we've just gone through a relet of the contract with Waystone. That's now commenced. I think it's fair to say the costs have gone up relative to where they were in 2017. But increasingly the investment in us as a client, and I think in the requirements we've placed on them, is also increased. So that's probably where we would expect it to be. Set up and oversight, these are costs that are incurred as a result of increasingly overseeing more complex products in some ways. and the evolution of what we already have. So, you know, the Active Sustainable Equity Fund that was launched during the calendar year, that's created more set of costs, but also more oversight specifically in those areas. And finally, the host authority is a very modest cost relative to what we might see with other pools. This is essentially just the administration of the day-to-day hosting of the platform. So I'm comfortable that we're overseeing cost. Clearly, cost is important, and I think the investment management fee savings are outweighing those additional costs. But we have to do more to enhance the governance, and I think make sure that that's still good value for money for our members.
Is that okay?
Thanks.
Betty, yeah.
Just one observation, when you do the fee cost savings in 4.3, you probably need to deduct from that the operator costs that you were just going under 4.1 to get a net savings.
I'm almost certain they are already deducted as part of that process, but I will double check that because it's a good point.
Do you want to finish off then?
Sure. So I think just to conclude, and this sort of takes back to the cover report, I think we're pleased with the progress that's being made. There is the next item covers the audit process more specifically, but what I would say is that the process is going as intended. We hope to conclude the audit in the next couple of weeks. There then will be a process to take the final version of this document through to the local pension board for that kind of scrutiny and oversight phase, together with the ISA 260 audit report, before coming back to the special committee meeting in November for final approval. So all being well, then we can achieve that publication deadline of the 1st of December.
Thank you. I've got David. Just to clarify, we can't take questions from the gallery in the meeting, but as ever, more than happy for you to stay and observe. So, David, any other members got any questions or points of clarification? David.
Thank you, Chair. I think, obviously, there's an awful lot of information in an annual report like this, and I think one of the things I found quite helpful was in the cover report, some of the key takeaways, and I think it's quite helpful to perhaps see that mirrored across into the annual report. And obviously, the Chair's input highlighting 3 particular points around local impact and responsible investment, future business planning, etc. I think was a good way of starting to do that, but maybe that's something that could be built on a little bit in terms of the officer contribution, or perhaps the front end of the report, that, if you like, backs up what the Chair has put in front of us. It's just that, with all due respect, I doubt there'll be many members who will read to the end, and it's useful to have some key information up front, as you did in the report. Thank you.
I think that's a very valid point. And actually, Alex and I were kicking around some messages yesterday about potentially looking at the format of the annual report and maybe revamping it ahead of next year. So, question actually, Alex: if members have got any, if members have the time to go over and might have any other questions or clarifications over the report, what is the final deadline from you that we would need to get any sort of comments or corrections in? Yesterday.
Ideally, as soon as possible. I would say maybe a week. I think by the end of this month at the latest, because we would have to make those final amendments alongside what we share with auditors.
Okay, I wasn't thinking we were being that generous. But can I say to anyone, if there are any issues you come across in reading the report by the end of next week, to get back to Alex with any. As ever, I'm here for my strategic brain, but I took my green pen out over the weekend. On page 121, the career service Gwent is missing a comma in the column. But this is a serious point. It's always good to have a fresh pair of eyes, because the amount of times you read our own documents and miss things. So yeah, if people can get anything through by the back end of next week, that would be very helpful. So if there are no other questions or queries, can I refer members to the cover report, to page 38, and point 5. The recommendation at 5.1 is to note the report. So people have members happy to do that. Excellent. And can I just again stress, can all members make sure they've got the extraordinary meeting on the 18th of November in their diaries? I think like last year, if it's easier, I think we're happy to make this an online meeting, as it should be quite a short meeting. to formally sign this off. So we will be sending notices out. If they haven't already gone out. They have gone out. I'm not on top of my inbox. There we go. We knew that one. Right, moving on then. Agenda item number 7. We've got the Greater Gwent Torvine Pension Fund Audit Plan for 2023-2024. This is Alex again, and this begins on page 151.
Yeah, thanks, Chair. And apologies to the members, first and foremost. This is coming to you a quarter later than has been the case in the last couple of years. As you can see on the top of 151, the Audit Wales issue date was July, so it missed the timing of the June meeting. I'm just bringing this purely for information today. It was presented to the Pension Board. As I said, they have this sort of effectively the Audit and Governance Scrutiny Committee role. And so the board have already considered this paper when Audit Wales presented it back in July. Members of this committee will receive a final version of the ISA 260 presented by Audit Wales at that special meeting in November. A couple of just key points, really. The audit planning document and process is consistent with prior years. The things to draw to members' attention, page 157 considers financial materiality. So essentially this is looking at the sort of the auditors setting a threshold around where the risk parameters are in terms of what they are assessing and consider. That doesn't mean they wouldn't go below, and in some cases they have sort of lower materiality thresholds for things like reporting. So that's been set at 1% of the fund's asset value, which is just over 4.2 billion at year end. So that materiality threshold for the financial year is around 42.5 million. I think probably just turning to the significant financial statement risks, which is on page 159. First thing to say, this is all fairly standard and nothing of concern to us as officers, and as actually was reported by the auditors themselves when they presented to the board. The significant management override risk, that's standard in any audit of this nature. And although the audit process is structurally separate between Council and Pension Fund, there are a lot of internal controls that are consistent, things such as posting of journal entries and the like. So a lot of Audit Wales testing on the Council's audit process will transfer across to ourselves. So I have no reason to have any concerns around that. The areas moving to page 160, which are becoming more and more significant and which members of this committee will be familiar with, is I suppose the risk or the valuation uncertainty around what is an increasingly big proportion of our fund invested in private market assets. On the public listed side, you'll be aware that you can obtain live pricing information on a lot of our investments, and therefore that third party can provide assurance to auditors about the value that we're disclosing on the balance sheet. In the case of the private assets, such as private credit infrastructure, these are harder to value. They don't have a listed price, and therefore there are valuation techniques and methodologies that are adopted both by the fund manager themselves, but also then sort of by the custodian in terms of arriving at that valuation. So there is a degree of judgment around that. There also is an issue with this in that the timing of producing those valuation statements typically are about 90 days post-quarter end. And so when we prepare the pension fund accounts, we typically have to use the December valuation and then adopt the cash flow entries both in and out of those investments to the end of March to provide our valuation. So I guess as we move towards the audit concluding much later in the subsequent financial year, we may find that final valuations do drift slightly from what we've disclosed, but we wouldn't expect that to be material, certainly below that sort of materiality threshold I referenced. My team have done a lot of work this year, and there's a lot of disclosure in the annual report per the prior item around exactly the basis of those valuations, and I'm satisfied sitting here today that we've adopted a sensible and pragmatic approach to that, as well as prudent. The remainder of those sort of financial risks that have been highlighted, one is around the present value that is placed on the pension fund liabilities at a point in time. This is entirely driven by our actuary, which is Hymans Robertson. and they operate within professional standards in terms of the way that they derive that calculation. So whilst we do sense check it and we review it for appropriateness and completeness, we don't have any basis in which to particularly challenge that. And I know that Hyman's do a lot of work with all of the audit firms, given that they sort of have 50% of the local government market, to provide that assurance. So that, again, I don't foresee any issues with that. The final significant risk is around the internal controls of the investment managers that the fund employs. So as you recall, we don't manage any money in-house. We externalise that process. And so the Audit Wales will always undertake checks against the internal control arrangement and environment of those investment managers. My team ask for copies of those reports routinely, and we review them and raise any concerns with the investment manager. And Audit Wales provide a sort of assurance over and above that, which every year is carried out. So that's the basis of those significant risks. But as I said, I don't foresee any issues against any of them, certainly at this stage. Page 161 just includes the timetable. We've referred to it in the prior item. I would expect that the final audit to have concluded within the next couple of weeks, and we are aiming for a final approval of the Pensions Committee in November. The final point just to mention, I think, probably is on page 163, which is around the fee and the audit team. The fee in particular is £53,186 for this financial year. That's about a 7% increase on last year, which is typically in line with CPI, 6.5%. I think it's noted above. So that's sort of in line with our expectations and within line with what we budgeted. So that's where we expect it to be. Final point at the bottom just details the auditors on the fund this year. There has been some turnover, say, for Richard Harries as the engagement director. Alice King and Danielle have both taken on the fund for the first time this year, but pleasingly are working with one of the other Welsh funds, so there is some consistency and some knowledge transfer from that process. I think that's probably all to say on the audit report. As I say, you'll have a more detailed ISA 260 that will follow later this year, but happy to take any questions.
Hey, thanks, Alex. And just to clarify, this is just for noting, isn't it? Yes. At this stage. So, members, any questions? And then also, board members or advisors, any comments you'd like to add? David.
It was really just to ask, Alex, have you seen any, the areas of focus comparable to last year, or is there a sort of a rolling pattern of the different elements they focus on year?
I would say it's fairly comparable. The big area is around the valuation, the certainty we're placing on the valuation of our private markets, given that it's becoming increasingly material. But again, no concerns. I think that the approach that we've taken is sensible, and we've improved the disclosure around exactly how we are satisfying ourselves of valuation. So I don't foresee any issues at this stage. There's certainly been nothing communicated to me of concern, given this late stage in the process.
Thank you, Alex. Anyone else? Betty.
Yeah, can I also say, with private markets, there's always this delay in getting the information, but even if you're using December 31st for a March 31st year end for the fund, typically the December 31st values have been audited by third parties for the managers. So they are, if anything, the most robust you can get. So that delay is probably favourable.
Thank you very much. If everyone's happy, then there's no votes, is there? No, in which case, if people are happy, just with note to the report, we can move on. Item number 8, then, is the quarterly investment performance report, which is a mixture of Alex, of Ethan, and of Betty, I think, reporting today. This begins on page 167. So, Alex.
Yeah, thanks, Chair. I'll just make a couple of very brief comments on this report, given that it's a standard quarterly item and hopefully the committee are familiar. I'll then just turn to both of our advisors, as the Chair suggested, to give some more context on the detail. So just a reminder, this is the quarterly report to the 30th of June. We obviously are currently almost through the third quarter, and you'll have an update on that at the meeting in December now. Headline messages: the fund had another positive quarter, up just over 2%, slightly behind the benchmark, it has to be said. that's about a 78 million increase to a fund value of 4.3 billion. Pleasingly, actually, over a 12-month period, that fund performance is up over 13.5%. Again, slightly lagging benchmark, and we can maybe touch on some of that in the detail. But I think, comfortably ahead of that long-term actuarial discount rate, which is the sort of minimum performance the fund needs to maintain to keep pace with our liabilities of around 4.3%. The other point I always draw to, not to try and get too bogged down in the quarter-by-quarter performance, is in paragraph 3.3, the bottom of page 167. Fund performance over those much longer time horizons is also positive, and I think that's a strong message in terms of where we are, direction of travel. This report contains an awful lot of information, and it's jointly worked up between officers and advisors. But I think rather than me try to talk to it, we have those much more experienced around the table. And so at that point, I think I'll turn to Ethan maybe on the macro to give some context, please.
Thank you. So, as always, I think it's important to set out why we give the context. It's always very interesting to speak about macro conditions, but in a vacuum, it's a question of nice to have, and I think the so what piece always has to be answered. And what I'd like to do here is just really restate the global macro picture, which I think will evidence why we have global exposure in the portfolio, justify that, and explain some of the potential challenges that will come to that as global conditions change, and also speak about the strength in equity markets. And that really is the real reason why our portfolio has done so well with its over 70% equity exposure. Clearly in excess of target, we're working it down, but it has been a nice tailwind to take the portfolio into its current state, which is very robust. And all of that helps, given some of the challenges for pension funds that are coming down the pipe. So where are we versus the last quarter? We didn't actually go into much detail in the last quarter, but we'll just pick it up now. Clearly, we have a situation that is somewhat changed in terms of inflation. Inflation does seem to have been tamed around the world. There was a big question as to whether it was in fact tamed by the restrictive interest rate policy, whether that had its desired effect, or whether some of the inflation was due to one-off situations such as COVID, and really the taming was just a natural reversion to the mean, and the dislocations working their way out. The reason it's important to trace whether some of this soft landing that we're experiencing, meaning inflation coming into check, no real recession to speak of, and a relatively robust consumer and corporate sector, despite having had this dramatic change in inflation, we have the soft landing. It's important to understand whether it was the knowledge and skill of central banks that steered us through this or not, because it would suggest whether or not we should have faith in the process and trust the equipment going forward, or whether we can't have the same level of faith in the process. That may be some kind of an academic question, but I think it is something to bear in mind, as we no doubt will be facing similar challenges going forward, and we need to know that we can trust our institutions to handle those. But we currently have inflation tamed, and now the shift is moving to the economy and jobs. Despite a tick up in the unemployment rate around the world, we're still looking at a very robust jobs picture. We're not seeing jobs and wages push inflation up by that much, but that is something that central banks are continuing to watch. So what is the natural follow-on from inflation moving into the zone? It is that central banks around the world can begin to take their foot off the restrictive pedal and dial into the easing pedal again. We've seen the European Central Bank with 2 rate cuts, the Bank of England with 1 so far, and all expectations around a Fed cut on Wednesday. They will be data dependent, but there's a sense that this will be a modest rate cut. This is important as it's likely to stimulate an economy which is still doing relatively well. Here in the US is clearly a juggernaut, has not experienced any recessionary indicators. The UK has experienced 2 quarters consecutively of negative GDP growth, which was a technical recession, but that was the end of last year, and this year so far we've managed to eke out somewhat positive GDP growth. Positive since we last spoke, an election that passed smoothly without any challenge to the transfer of power, which sounds like it shouldn't be notable, but in the context of the US is notable to say that democracy has worked as it should. Equally, it was widely anticipated, the results, so no surprise there to churn up markets. And there was a sense equally that whatever was coming could not have been perhaps as disruptive as what had just been seen. So there was a sense that stability would be good. And despite that, so we've seen some positive growth in the UK. Despite that, there's still a suggestion that austerity is coming, a difficult budget is coming, and we have had a reasonably mixed economic picture in the UK. Inflation is down, we've had one interest rate cut, but and we know that house price sales are up, retail sales have been somewhat supported, but we have the winter coming, potentially high prices coming, more impact of Brexit coming in terms of potential trade imbalances, and overall a bit of a mixed picture, and that would be similar to what we're seeing around the world. Resilience despite some of these mixed pictures that we're seeing in terms of some outlook from corporate companies. So I'd say overall in the UK, this is page 178, modest growth but grim forecasts. When it comes to looking around the world, we clearly have a relatively strong economy, which is why the markets have been supported. But what we do have is serious geopolitical headwinds and potential surprises unfurling. It's been described, I think I've used the term, as a geopolitical recession. Why is that important, that geopolitics is swirling out there? Because it hasn't so far upset markets, but it could. And one of the things that I think our portfolio is exposed to, just like any global exposure, is the US election in November. Because the US election is still on a knife edge, and it actually is quite consequential in a way that elections have not really been as consequential before, because the divergence in policy is quite stark in terms of what it means for trade and potential inflationary measures that would follow. So taking President Trump at his literal word, we would see high tariffs emerging should he be elected. Tariffs clearly are inflationary for the US. That would actually, but tariffs are equally a zero. They're not even a zero-sum game. They're net negative around the world. So tariffs will be very poor for the US in terms of their inflation. They would also be poor for trading partners. They would be poor for Europe, poor for Asia. So everybody loses in a tariff situation. And if that is in fact the case, that he would come in, this would be very negative for many countries around the world. And sectors themselves, such as ESG, sustainable investing, that's likely to be underinvested in. We would see fossil fuels perhaps thrive if they go with their drill, baby, drill policy that has been stated. And equally, we would see a divergence in company outcomes with corporate tax cuts on the one hand, but company margins under pressure because of the tariffs on imports. And equally, we would probably see a rising budget deficit in the US. So that is quite poor. It's actually it's quite unclear right now whether that would result in a stronger or weaker dollar. Both sides could argue for either one, but a weaker dollar is poor for your portfolio because so much of your portfolio is in non-US, in non-GDP, non-sterling assets. So and most of it is in, given the global equity exposure, most of that is in dollars. So that could be very poor. So we are right now watching the markets very carefully to see how they fare with the election pending. We have seen just in August that the markets can be quite dislocated when there's a chill like there was in Japan. That just took one very small interest rate move by the Bank of Japan. Very quickly then we saw the carry trade becoming unwound, and as was shown in 180, a real spike in volatility just because there was a carry trade, a widely held trade unwound, much more volatility than any of the geopolitics had brought forth. So markets are on a knife edge, and I think will continue to be so and uncertain as we look to the future. So that's your equities. They've done extremely well, but it may be that they've borrowed from the quarter ahead. They may be a little overbought at this point. You don't have purely tech stocks. You have a broad-based equity portfolio. That's good news because tech has been dominant in the US, but there has been a rotation into a broader segment. So having a broad-based portfolio has paid off, and I believe will continue to pay off regardless of the outcome in markets because it is broad-based, it has a mix of defensive and growth. Growth has been the only game in town, but when there is a jitter in markets, there's a tendency to rotate into growth. Out of growth and into value. What does an interest rate change mean for you? Well, certainly interest rate cuts generally are stimulative, so that should be good for other aspects of the economy. It would mean that fixed income that you currently own could do better in a rate cut environment. They will rally. The ongoing run rate for cash will not be as high, and the ongoing achievable return for private credit and other fixed income achievable going forward will not be as high. This will make bond substitutes more attractive. You have many bond substitutes in your portfolio, such as real assets, infrastructure, real estate, as well as value equities that pay dividends. They will all rally when bonds look less attractive. So having this all-weather portfolio that you have should benefit you when bonds fall off somewhat. But we don't believe that, well, at least I don't believe, that, that rates are going to go down by that much. This is one of the most shallow expected easing cycles in recent history, that they're expecting rates to bottom out at around 3%. So not going down to the 0 rate we had before. So even 3% with inflation around 2 is a decent level for a real return, a decent level for cash. So we're not in a situation yet where we have to be concerned that cash in the portfolio is a drag. So enough interest to make sense to hold cash, but not necessarily enough to be sitting in cash. We would want to be seeking out risk from there on. Equally, as rates come down, that makes real estate, unlocks real estate, because people can borrow again to actually borrow and buy real estate. It can unlock sales, and it makes business models make sense in infrastructure again, because many infrastructure business models are set up with decent yields, but not fantastic. They don't make sense if rates are too high. So all of this unlocks some of the real assets that have been a little bit stagnating as rates have been very high. So again, plays into the non-traditional part of your portfolio. So just in terms of what are we looking at the rate as we now sit here, middle of September, next time we meet, we'll all know the outcome of the US election. Well, between now and then, we clearly are looking closely at whether equity markets can sustain their current strength, and whether there are cracks like we saw in Japan that could potentially attack them. They seem very resilient, almost anti-fragile, which is a word I've used before, because it seems like no matter what weakness comes up, equity markets stay well supported. So that is good news for you. And we're going to see how big the Fed rate cut is. One is inevitable, because we'll get a good signal from that about their concern about the strength of the economy. And then we'll also see what else starts to move once that rate cut comes into place, thinking again of your real assets and real estate. Clearly now we're looking at the election outcome. It's not just one country that will be affected by this. There could be other geopolitical situations, such as in the Middle East and in Russia, Ukraine, that could take a different direction once this election is held. So that so far has not shaken the domestic markets too much, but they could. I think one thing we have to bear in mind is that they could. So that's really where we sit here in mid-September. I'm happy to take questions. And there's also a table in here about the Trump trade and how we would think certain segments will react to a Trump victory or not. So, again, very much watch this space.
Okay, that was fascinating as ever. Again, we'll take stock, and if anyone's got any questions or comments on what Ethan has just outlined from the macro update report, we'll take those first. I've actually got a question, but again, as ever, I'll defer to members if they have anything they wish to ask. Right, I'll take Councillor Best, then Councillor Williams.
Just a question really on clarification, if it's possible, over what a Trump presidency would look like, because you've spoken about intentionally lowering the US dollar, and then also speaking about tariffs on countries that decrease their dependency on the dollar. Is there any making sense of that on what will come out of it? Is there any sort of like Liz Truss doomsday scenario that we could be looking at? And then similar question, in the Fed lowering rates in the US, do you think they've been reluctant now to lower rates with the possibility of a Trump presidency looming and the economic uncertainty that comes with that? And if they are, I know you said in your report that the independence is at risk with the Trump presidency, but is there any risk that comes from that?
Two excellent questions. I'd say you're not the only one who's a little bit looking at both arguments for the dollar strong and weak, because that's quite a bit of confusion coming from that. There's clearly a strong dollar, America first rhetoric. It all ties in very well. No country wants to think of its currency being weak, even if it does benefit exporters, and certainly it doesn't line up with the Trump rhetoric. And although a weaker currency, as I said, would benefit the US in some ways, and is supposed to be becoming, there's a sense that most of the policies in place will actually strengthen the dollar because that the tariffs the protectionist regime will tend to strengthen the dollar relative to its trading partners, potentially because the trading partners will struggle so much with tariffs that it could actually, they're already compound already negative situation. The strength of the dollar is not just due to the US's own juggernaut strength, it's also due to the relative weakness of some of the euro, and Japan's weakness is not sustainable for its yen's weakness either. So I'd say that real mixture, but clearly a weak dollar does not tie in well with the America First philosophy. So it's likely to remain strong, and that again is bad news for many importers. So as far as what the Trump doomsday scenario and whether that could translate, there's actually many doomsday scenarios around Trump that have not even been fully rehearsed in the media. I listened to one strategist on Friday speak about it, who talked about what could be done potentially with Project 2025 and really unrooting many of the federal agencies, and the level of just the sheer chaos that would cause in terms of choking off processes such as the Internal Revenue and other processes that may be inefficient and bureaucratic, but at least work eventually. So that could be a massive upheaval that would be actually very recessionary and very much cause stagnation. That's just one. And where there are things like removing the filibuster and other overhauls that have been promised, as well as some of the social policy, that could be very disruptive as well. So a lot of concern around what that could mean. As far as the Fed and their policy, for now, I think there is a question mark I have on the table about Federal Reserve independence under a Trump administration. But that is clearly a big risk. And you talked about that before, and we don't, I think, have to worry about that just yet, because they still are independent up to now. So I don't think they will take any decision on interest rates based on political outcome at the moment. They will base a rate on data dependency, and that's what they've said over and over again. They will base any cut they make on what the data says. And the sense is that there's definitely going to be some change, but there's a sense that they don't need to go overboard with a 50 basis point cut just now. So clearly, Trump would love them to stimulate the economy. I think that would actually be quite supportive. So maybe they won't do a big one because they know that there could be both presidential candidates would welcome another one in December. So maybe there would be another reason for that later. But I don't get the sense they will do anything politically motivated just yet.
Okay, thanks, Ethan. David.
Yeah, thank you for that. I was looking at the points that you noted on page 184, which is about potential government policy around UK pension funds investing in UK equities. Even noting that 4.4% of UK pension assets are held in domestic equities. I think our proportion is probably a little higher than that from the previous presentation from Alex. So it was really if there's any kind of impact you think might accrue from that.
It's another great question, and the irony of this is that one of the reasons for the UK pension plans holding so little in UK pension assets is because of the de-risking and strict approach to liability hedging that was not quite mandated, but essentially mandated through the pension regulator. So that strict focus on funding levels and funding adequacy forced many pension plans out of risk assets into liability-driven investing. It was that liability-driven investing, when hedged, which we did see much of that, which actually caused the near collapse in many of these plans during the trust economics, and that then the LDI crisis, the gilts crisis, that caused them to downsize even more. So there's actually been this kind of spiral, this negative spiral effect, where many DB plans in the UK cannot afford to own many risk assets. They simply don't have the asset base to do so. And then with the loss of confidence in the UK, whether that was precipitated through Brexit and follow-on economic conditions, they have not had a lot of interest in non-UK institutions holding UK equities. So the UK, there hasn't been much support outside the UK either. I will say that around policy investing and mandating investing back in UK equities, there's a lot of resistance to that, and rightly so. it is seen as inappropriate that governmental policy would dictate where equities are held or not. Certainly, it's not unusual to encourage domestic and keeping local investment local, and that is being discussed. And the question is, as long as that is held to the same standards as any other form of investing, bearing in mind that fiduciary duty is to generate a return that allows these pension funds to meet their obligations, as long as that is maintained, that there is seen as being a double benefit to investing in the UK, and this twin aim is justifiable. But I would say forcing more investment in UK equities will be lowest of the pecking order of a policy that will be successfully welcomed, because that is seen as being too interventionist.
But hold that thought, because we will come back to it later on. Betty.
Yeah, I just wanted to, first of all, echo a lot of what Ethan said. I hope there's no echo on this. But just to distinguish your last point about, people, these defined benefit pension funds being forced out of holding UK equities, and actually a lot of equities at full stop. That's talking about the closed defined benefit schemes, which is not the LGPS. I think it's really important to distinguish. On the other hand, in my opinion, a lot of consultants have run around and tried to sell to the LGPS the same strategies that have been appropriate maybe for the closed schemes, but which are not appropriate for some LGPS. And some LGPS, unfortunately, I think, may have drunk the Kool-Aid a bit and done things which didn't really make sense. Now, we resisted this, and we also have always maintained a UK allocation just because it's diversifying, and for so many years it's just been so cheap. I mean, why would you take a bargain and see what happens? So those are my two commentaries. And then I just wanted to ask everybody, please, to hold in mind some of the comments Ethan said about bond substitutes. Also remember that as UK rates start to fall, interest rates on our cash will fall. Japan currency rising, especially versus the USD, but other currencies on the back of actually very small interest rate rise, but a change in positioning. Rising volatility in markets, skepticism about growth equities, and US dollar weakness, and then also just long-term views, because those actually, they dovetail very neatly into discussions that we'll have in the exempt minutes.
Thank you, Betty. Now, do any board members have any questions they'd like to raise? I see Steve, and I've got a question, and then we'll move on. Thank you.
Just quickly, interesting table showing the winners and losers if Trump did come in. I found that really interesting. What's your thoughts if Trump doesn't come in? Is it more of the same, or is there something else on the horizon?
Well, that's a great question. I think, but there's certainly both candidates are proclaiming to be a change candidate, and it's for a continuation. There has to be some change in place, even though the economy is doing relatively well at this juncture, given where we could have been, given hard landings and soft landings, etc. I'd say for this, there's actually, let me just very quickly bring up another slide that I was using for another presentation last week. The key differences on trade, but the key difference is on trade. I think we can definitely, we will continue to see some tough rhetoric around China, but we're not likely to see anything like the tariffs. We're going to see continued reshoring, tech and materials. That's clearly a popular policy. There's a big difference in terms of corporate taxes, whereas there could be a tax rise in the Harris administration, but not likely to be as high as Joe Biden had proposed. But there's also likely to be more concessions towards families, such as more child tax credits and other general childcare, and also breaks for first-time home buyers. There are likely to be more middle-class-centric set of policies, as opposed to this bifurcated tax cuts for the companies and for the very wealthy, which we're seeing under, and that's really a continuation of Trump's policy. The other thing that's likely to continue is the Inflation Reduction Act, which was bipartisan legislation, which was passed by President Biden, is actually, some of that is stimulating solar panels and other sustainable energy and renewable energy, and is actually electric vehicles purchased. That benefits the predominantly Republican states much more than Democrat states. So even though it's a policy that is associated with the Biden administration, it would be extremely unlikely for Trump to want to overturn that, because there's so many benefits coming to that. So in a Harris administration, we would see a continuation of this combination around whether it's a Green New Deal or whatever else there's considered around that. And there is a sense that there's actually quite a bit of the tough talk around both trade, as well as definitely China, as well as but definitely more shoring up of NATO and other this is on the international stage. So I can share that chart later, which is an interesting chart.
If you would, that'd be very helpful. Yeah. I've got one more quick question. I think we need to move on. Being parochial about the UK, and it's just a question, which I guess takes us into this quarter. Is there any sign that the new government's narrative setting about the state of the economy is having a negative impact on the UK market?
Not really any signs. I mean, we still are in the positive GDP growth territory, and even though there's this sense of austerity coming in the budget, even today there's a sense that this lack of the spending cuts would take away what it means to be British, or would actually just fundamentally undermine the fabric of the economy. So, and there'll be tough talk, and we've seen some of the tough talk around pension reform. The action hasn't followed yet. The action may look less drastic than than some of the talk. And similarly on the economy, I think sometimes, just as in the US, this severe approach to tightening had the effect of reining in expectations and around how much could be spent, because expectations were set around inflation, and that reined in consumer spending. So sometimes the talk can have the effect as opposed to the action having to follow. So I'd suggest here in the UK, the talk around austerity has that chilling effect, the cold shower, essentially on the on economic outlook, which can have the effect of bringing in expectations, which reins in inflation, without actually having to take the tough thing.
Okay, thank you very much. Back to Alex then to look at the micro aspects of the report, if that's what you're going to do.
I was just going to make one
comment.
On the table.
We've not communicated this quite
very briefly, I think, because given it's in the cover report, so just referring to page 172 and 174, but taking 172 first. So this is a snapshot of the fund where it is at the end of the quarter in June. Clearly, there is some drift that continues between the strategic allocation that was agreed by the committee last year and the actual allocation at the point in time. For all of the reasons that the committee have discussed and we've discussed previously, I think increasingly, if I move to page 174, the use of the private markets table should now start to be read in conjunction with that former table, not in the sense of performance return expectations, because it's too early to see that. But I think what the point I was hoping to make here is that as we increasingly commit to the private market allocations across infrastructure and private credit, but also what we expect from real estate in the coming months, we should start to see those overweight equity positions coming down in favour of the private market. So that was just an observation, really. And just a final point around positioning of the fund performance relative to the peers, to our peers and the scheme. PERC, which is essentially a research consultancy, produced their report on an annual basis. I'm happy to share that with members after for your own sort of time to read through. But I think very pleasingly, the fund sat in the upper quartile on a 1-year basis, 3-year and 5-year, and an upper median over 10 years. And so performance over the long-term period across all of the fund's assets has performed very strongly relative to its peers. So I thought that was useful to mention as well in the context of this report. So that's it, Chair. Thanks.
That's all me. Okay, if everybody's happy and has no more questions, can I direct members to page 175? The recommendation at 11.1 is that we note the investment performance for quarter 2 of 2024. Everyone happy to note the report? Yep. Fine, that's passed. Thank you very much. Agenda item number 9 is the Wales Pension Partnership WPP update. This is also with Alex and begins on page 209 of the report.
Thanks, Chair. Again, another standard quarterly item. I think really key messages here. This covers all of the updates for the Wales Partnership to the last formal meeting of the Joint Governance Committee on the 17th of July. There is actually the next meeting on Wednesday of this week, and so we're a couple of days out of being able to give you a more timely update, but I think in essence this report provides that. There are a copy of, as ever, the draft minutes of the Joint Committee meeting in July in the appendix for your information. We've also included the Waystone update, which, as I referred to earlier in the agenda, is the operator for the pool, and that essentially captures a lot of the summary information in this cover report, which you can read in your own time. Page 210 of the report is a snapshot of the fund's exposure to the relative WPP-related investments. I quoted a figure of 74.5%, I think, of pooled assets, which was at the reporting date, 31st of March. As of the 31st of July, which is a more timely update, that's just over 77%. So I think really pleasing we're moving to well on our way towards that sort of the target of having the majority of our assets in the pool over the long term. Members should recall, and I'm referring to page 211, that there was a decision around appointments of real estate providers, or allocators as we've termed them, for Wales at the last formal meeting in June. At that time, given that it was going through the Carmarthenshire's procurement process, we were unable to disclose specifically the names of those appointed companies. I'm pleased to be able to share that now. And so just to confirm, Schroders have won 2 of the 3 mandates. They are complementary in the sense that they are UK-focused. They offered a very compelling fee discount in order for both mandates, but over and above that, their skills and capabilities around what we were seeking to achieve were shone through and were very attractive to us. And so I'm pleased that we've been able to appoint Schroders. And on the global property, which is an allocation that the fund historically hasn't had exposure to global property, this is a mandate that's been won by CBRE, which again is a global operation, and I think will be very complementary to that sort of 3-strand approach that we've chosen to take. So Betty and I have had an initial meeting with Schroders, which I think was quite encouraging, particularly if you think about the UK-focused impact and how Schroders believe they can demonstrate investment in Wales particularly, and that mandate, although still to be determined exactly how big that could be, up to sort of £500 million realistically over sort of the next 5 to 10 years potentially. And so I know that this committee has expressed a desire to be thinking about that local impact focus, clearly with preference for Wales where we can get it. We talked about our 20% exposure already. This is another opportunity, I think, to further increase that. So quite excited about the real estate proposition. There will be a period of time for all of the legals and all of the sort of formalities to be finalised, but we're hoping we can run that process, or the WPP rather, with its legal advisors, can run that process alongside thinking about implementation of strategies. And so I'm hopeful that we can bring a recommendation to this committee in December around proposals for how we might allocate to those real estate strategies. The final point to the bottom of paragraph 7 on page 211 is referring to some other fairly significant procurement exercises that are now underway. We've talked about these previously. Robeco currently have the voting and engagement contract on behalf of Wales, and Heinz Robertson are our oversight advisor. So that's not an investment consultant, it's essentially a governance advisor, and they help to oversee all of the activity of the pool, but also oversee investment management performance. So there is an element of the investment consultancy that feeds through. Both of those contracts sort of expire around the end of the calendar year into the very start of 25. And so we've allowed sort of a significant 3-month period to run those processes with a view to reappointing by the new commencement of the contract. Both of these contracts are being run off the national framework, the local government national framework. So, if you like, the best-in-class providers are on both of the lots that we are proceeding for, so we would expect to have strong interest from the market and be able to assess credible submissions in the next couple of weeks. I think, in the absence of our chair, that probably concludes this item. I'm not sure, Councillor Williams, if you're taking over temporarily, whether you've got any questions.
I think I'm taking over temporarily, Alex, yeah. So it's really just to open it up to see if colleagues have any points they'd like to flag up. Colleagues on screen? No? No? Anything from... And anything... Betty?
Yeah, can I just say, I think having a dedicated sort of allocation within the real estate for the pool to the UK and focus a lot on Wales is really quite innovative. None of the other sort of pool companies have done that. I mean, they've got, you know, UK kind of and global, but, you know, this really kind of impact sleeve, you know, in bright lights and really focusing the mind is quite an innovation. So I think it should be applauded and noted.
Yeah, thank you for that. Great. Just think of a comment I wanted to make. Yeah, it's really just to ask really further to your point at 7.1, Alex. You indicated that these significant procurement updates have been running. When do we expect that new providers would be on board in terms of the pool?
I think given the timelines that we are working towards, we would expect both providers to be in place by early 2025. I'm pretty sure the one contract is January and the other might be 1st of Feb. I confirm the dates, but it's very early next year, post the finalisation of the procurement process.
Thank you. Welcome back, Chair.
Thank you very much. I was about to say thank you very much, but maybe not. Right, in which case you could have finished that off. Draw your attention then to the recommendation on page 211, no, 212 rather. So the recommendation at 9.1 is that we note the report. Yep. Carl, John, there we go. A roving vote. I'll take that as a yes. All right, fantastic. That's 3 out of 5 anyway. So that's carried. Agenda item number 10. This is the draft risk register, which is also with Alex. This begins on page 237 of the report. As this was an update for discussion, yeah, Alex, over to you.
Yeah, in essence, there's no confusion. Well, hopefully no confusion here. This is a report that was taken to the board in July. I think the approach, just as a reminder to the committee, is that the board had taken a real lead in, I think, in the approach the fund takes to risk management, both in terms of its policy and the risk register itself. And so typically we spend more time with the board working through the detail and then present essentially the findings back to the committee on a quarterly basis. And so at the board's next meeting in October, we will carry out a review of the prior quarter. No change to the approach that we've taken over many years, really, with this. I think what I would say is that we've enhanced that, and credit to the board, really, for the feedback and the support that they've offered. The cover report summarises the approach we take. In essence, we now have, following the changes made last year, a two-tiered approach. So we have a sort of dozen strategic risks, which we believe are the most significant in terms of the management of, and if not managed, could have impacts on the fund. But what sit below and within those strategic risks are a handful or a number of operational risks day to day. So typically they like to think those being managed more by my team and I. The strategic, I think, really are the ones that should be on both committee and board agendas on a regular basis. What we agreed within the risk management policy is that we would typically bring forward all of the strategic risks quarterly, but at one point every year, so on an annual basis, we would bring the whole document so that members could sort of work through those operational risks as well. And I think at the meeting in July of the board was that annual review point, hence that there's more detail that sits within this particular report. And I will go through, I think, one of the appendices, rather than all of the detail. There's one appendix which I think summarises the latest work that we've done. The final point I would just mention on the cover report before I do that is on the bottom of page 238. Given the size of this document, it's an inevitable consequence of the extent of the services we provide from the administration of the scheme, and obviously our responsibilities to the pensions regulator. Plus, then you obviously have all of the investment management arrangements, which have taken a substantial part of this agenda. we feel there may be scope in future to kind of break out some of the risk register review into kind of like a risk in theme. So essentially focusing on one of the three broad categories of administration, finance and investment, and the governance aspects. And to try and cycle that discussion around topical events so that it's more meaningful. So an example could be, and I think obviously today we've missed the opportunity, but this cyber security training that's going to follow, so we could focus on some of the administration and the impact of that. But we also have the triennial evaluation coming up. That's a 3-yearly process, and so it may make sense to consider the risks around the valuation process over the next sort of 12 months as we go through that process. So it's trying to time the training and the education around the risk management as well. So that was a suggestion. I think the board were broadly supportive of that. And I think going forward, we're going to try and adopt that and obviously welcome views of the committee in terms of the relevance and whether that is helpful. I did just mention I would summarise where the review got to with the board in July. And I think rather than going through the main document, I'm just referring to an appendix which is on page 206, I think it's 253. So it's slightly difficult to pick up because of the text behind it. It's essentially a Word document that has strategic risks in the left-hand column, and then it moves left to right. So what this maps in a two-page document is essentially all of the earlier appendices on the full risk register. And from left, we've highlighted those strategic dozen risks or so that we mentioned. And to the right-hand side, we've then linked the associated operational risks. And so what we've tried to map, one is to give you the picture of what sits behind. And I mentioned, I think, if you take, for example, SR7, Strategic Risk 7, which is around actuarial and investment advice, there are a lot of operational risks. Most of these are dealt with as part of the valuation process that we go through with Hymans and with our own investment advisors. And as I was just saying, I think what might be helpful is we choose a risk in theme around the valuation process so that we can actually get into some of the detail there. So you can understand sort of why some of those risks are being driven. And naturally, a lot of them are relatively low, but I think in aggregate can form a medium long-term risk, because if the assumptions we adopt turn out to be inappropriate, then they can have longer-term implications on the fund. So that's the sort of logic behind why we mapped this document in a summary form. The red text just acknowledges where there were some changes to prior versions, and anything I should have said at the start, anything highlighted in yellow within the actual risk register itself is where there's been an actual risk change, whether that's score, a risk has been removed, or a risk has been added. And so it's a comprehensive document. I realise there's an awful lot of detail there to digest, and probably not within this meeting, but I'm happy to take any questions and pick this up, informally if helpful in future as well.
Yeah, you beat me to it. I was going to suggest actually if it might be worth actually going over this informally and having a conversation with Alex outside the meeting if there's anything specifically people want to drill into. But if there are any sort of headline questions or comments, looking at Councillor Williams. David.
Sorry, I just noted on the bottom of page 244 you make point failure to comply with miners' investment principles. It'd be helpful, not in this now, to tell us what the miners' investment principles are, so we have some outline that can put some context to that. If I could flag that as something as a request.
Request accepted. Alfie, anything? No?
Just to comment on the merits of a risk in theme approach. I think it's a good idea.
Thank you very much. Chaps, on the line? Happy? In which case, I will draw people's attention. Oh, typical, I didn't bother on my annotated notes. I didn't write down what page we had to look at. Apparently, page 239, the recommendation is 6.1. Point 1 is that we note the updated risk register and the changes proposed following the quarterly review, and then comment on the merits of a risk and theme approach. I think we're happy with both of those. Are people happy to vote that through? Excellent, done. Item number 11 is elected member training. So back to Joanne. This begins on page 255.
Thank you, Chair. So the first part of this report, members will be familiar with. It discusses members' training logs, and in the appendix is the current year's training log and last year's training log, and also a list of the forthcoming training for 24-25. If there's anything on the training logs that needs to be recorded that hasn't been, please let me know. and also if there's any additional training in the training programme that you would like us to cover, then please let me know as well. The next two parts of the report cover potential training and assessment opportunities that are available. So first is the National Knowledge Assessment. If members cast their mind back to 2 years ago when a number of you became members for the first time, you participated in the National Knowledge Assessment. So this is provided by Hymans Robinsons, our actuary, and as the fund is committed to ensuring independent training assessments are carried out for members, this is a good opportunity to participate in this and be able to record members' knowledge. Independent assessments can help us inform and develop our training and our training plan. And as a result, we are committed as officers to participate in this in the forthcoming assessment, which will be launched in September. So the assessment is designed for Pensions Committee and Pensions Board, as it was the last time, and it covers the levels of knowledge across 8 key topics. The questions in the National Knowledge Assessment have also been closely aligned with Hymans LGPS Online Learning Academy, LOLA, which I'll cover details on that below. So the National Knowledge Assessment will provide a number of benefits, and as a result, we are suggesting to go ahead and participate in this year. And details of this will be forwarded on to members once we've received them. Just moving on then to LOLA. So as you're aware, Pension Committee and Pension Board members have responsibility for ensuring that they have the appropriate level of knowledge to carry out the roles of both. And this is set out in the training policy. I'll follow discussions with Hymans Robinson and in recognition of the pension regulator's new general code of practice, officers have determined that it would be beneficial for us to participate in an online training function to provide for members of the committee and the board, which is LOLA. And basically, LOLA consists of short video presentations, supplementary learning material and quizzes that can be completed by members at their convenience, and it will support ongoing training and development. So there are several benefits of LOLA. As I mentioned, you've got videos on demand. We can monitor the progress. There's hot topic videos and jargon busters. And the online training course will also mirror the topics that are covered in the National Knowledge Assessment, which we're going to participate in September. There's also a current issues module, which will cover things, well, recent topics have been the pensions dashboard, the GAD section 13 and cyber risk. So details of how to access LOLA will be circulated to Pensions Committee and the Pension Board in due course. And if I have any questions.
Well, if you allow me to be flippant for a second, I'm looking forward to the jargon buster. I'd be interested to see what the definition of jargon busting will be compared to what mine might be. I've got a question, not a question, I've got like a reflection, but does anybody else have anything they'd like to say or ask or scream or David? No? As we know, I mean, I found the last lot of training very interesting. Like you said, we'd all only been on the committee for about 3 weeks, it felt like it, so it was like swimming through treacle. Hopefully we'll do better this time around. But can I make a suggestion or a request? I think I mentioned this to Alex yesterday. Before we press the button on this, it might be worth it if members, again, if we actually put some time in the diary, it would probably have to be in person, I think, just to have a bit of a refresher with officers here, just to get our brains working in the right direction before we sit the test. I would very much benefit from that, I think.
Yeah, I'm sure we can arrange something, yes.
Excellent. Right then, anybody else? No? In which case... Yeah. Recommendations on page 257, and again it's 6.1, recommended that the committee notes the annual training programme and then we agree to participate in the National Knowledge Assessment and the online training tool LOLA in due course. David.
Does this get reported anywhere else? Because are we under scrutiny somewhere else? That's what I was wondering.
I think firstly, I mean, Joe mentioned it, but this is one of the pension regulators' requirements, and one of the good governance recommendations was that there's an independent assessment of knowledge undertaken. We have previously carried this out, and I think we were one of maybe 19 funds in 22. So I think it reflects positively on the fund, first and foremost. It doesn't, whilst the results would be reported in a consolidated report, they are anonymised in the sense that no individual... And actually, the point that should come across is that no individual's results are to be scrutinised. It's essentially looking in aggregate at knowledge. And I think the regulator also recognises that different individuals bring together different skills. The board would also participate, provided they were supportive. And I think generally what we try to do is use the output of that information to think about where we need to inform our training. So hopefully it's seen more positively in that sense. But... yeah, to reassure you, you wouldn't be exposed in terms of your knowledge relative to anybody else across the scheme.
There's no sackcloth.
Thank you.
Sorry. Oh, Jesus. Sorry. Right. Item number 12, date of the next meeting. This is for noting only. There are two meetings to make members aware of. There's the meeting that we're going to put in the diary on the 18th of November, likely to be online, and this is purely to sign off the annual report and the figures. And then the next scheduled full meeting of the committee is on Monday, the 9th of December 2024. Are people happy with that? Item number 13. So, item number 13, to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, open brackets, as amended by the Access to Information Variation Order Wales 2007, close brackets, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest in disclosing the information. So are members happy to agree to exclude the press and public? Thank you very much. If that's the case, then if members in the gallery and members of the board, please could you leave the meeting? So we've got confidential items to discuss. I'm happy to take a 5-minute break. And actually, Zahid,